Yeah, I certainly like the investment style of the Macrobusiness Fund in terms of reducing the upside, in terms of dramatically reducing the sort of downside risk and that sort of thing. I was chatting to Damien before. Obviously, the fund is a long-only fund, so if there is a GFC sort of type event, the fund is likely to lose money. So I guess focusing purely on the downside as opposed to the upside, if house prices do come down, is the fund likely to lose less than house prices, I guess, is my ultimate sort of question.
That's a difficult one.
Well, let's just use broad figures. Let's say tomorrow let's say that tomorrow stock markets fell 20% tomorrow. So we're 50% in international. We think we'll claw back maybe close to 10% from the Aussie dollar falling. So half your loss. So you're down 5% on your international. 15% Australia falls 20%, so you're down 3% there. That gives you 8% you're down. And then your bonds will make a little bit back. You might make 1% or 2% back on your bonds. So if that was the scenario, that's sort of what I roughly think. If you had a 20% fall, we'll be down hopefully less than 10. Yeah. Sort of, like to think it's not too far past 5, -5 is my rough guide. And then that's because we're quite conservatively placed at the moment, and we're sort of, if markets keep rising, which I think they probably will for a little bit, we'll just keep winding more and more cash, so that So I guess that's my ballpark. And then if you're, depending on what funds you're in, like if you're in the income fund, you'll hardly fall at all. But having said that, you're not. If you're 100% in the income fund, you're not getting much on the way of upside either. That's basically just a term deposit plus a couple of percent on top of that term. So yeah.
Because we saw in that chart before, in terms of house prices, the drawdown on
the drawdown on house prices over the last 30 years, and there were a few periods of 12 months or 18 months where they sort of dropped 10% or that sort of thing. But I would imagine over the last 30 years, the drawdown on various managed funds would be a lot more than sort of 10% or that sort of thing.
Absolutely. Yeah, absolutely. That's right. The question is, will you get a house price move? And other countries have had house price movements that are significantly greater. And also, and the other part is most people are leveraged into their house price as well. So the actual movements.
I personally think the house price move will be significantly larger this time around. There's a couple of reasons for that. Previous corrections, so the ones in the 80s, etc., they had very big real house price declines, but we had very high inflation then and high nominal wage growth because of the high inflation. So the unwind happened, partly on not very much on the nominal side, which is what you see. It happened behind the scenes through inflation erosion. Nowadays we've got very little inflation and very little wage inflation. So what that means is that any correction to bring house prices back to some semblance of fair value has to happen through prices rather than through inflation. So you can't rely on the value being inflated away. On top of that, obviously, they've obviously increased by, as I put up in my presentation, about 150% in real terms in 20 years. And obviously household debt is at levels we've never seen before. So I think I don't know how long it's going to take. There could be a few, bumps along the way, but
plenty of political will to keep it going.
Yeah, plenty of pork to keep it going. But the corrections will have to be bigger than previous ones.
I guess the way we've set it up is that the Aussie dollar is the difference by and large. Like if there is a sizable housing correction and it's attached to a global shock, then the Australian dollar offers you a huge hedge in terms of your international holdings, which you don't get on housing.
The Aussie dollar fell just below 60 during the GFC. It was only for a short time, but
yeah, roughly something like that. Yeah.